What happened after Glass-Steagall Repeal historically? Have you ever wondered how the financial world changed after the repeal of the Glass-Steagall Act? This legislation, passed in 1933, was designed to keep commercial banking separate from investment banking. It aimed to reduce risks and conflicts of interest in the financial sector. However, in 1999, key parts of this act were repealed by the Gramm-Leach-Bliley Act. This allowed commercial banks, investment banks, and insurance companies to merge and operate as one entity. After this repeal, the financial industry underwent a major transformation. Large financial institutions, often referred to as universal banks, began to emerge. These banks combined the functions of commercial and investment banking, leading to a significant shift in banking culture. Institutions that once focused on conservative lending started to engage in riskier investment activities to boost profits. Many economists and commentators believe that this shift contributed to the financial crisis of 2008. They argue that the repeal encouraged excessive risk-taking and created banks that were too big to fail. The blending of commercial and investment banking is thought to have led to conflicts of interest and fueled the housing bubble. Increased involvement in securitization and speculative credit products played a role in this crisis. Notably, Nobel laureate Joseph Stiglitz pointed out that the repeal shifted the culture of commercial banks toward the riskier practices of investment banking. However, there is ongoing debate about how much the repeal of Glass-Steagall actually caused the crisis. Some experts suggest that the financial crisis would have happened regardless of the repeal. They argue that the investment activities of commercial banks were not the main reason for their failures. Others highlight that the crisis stemmed from a complex mix of factors, including poor regulation, risky mortgage lending, and global financial imbalances. In the wake of the crisis, there were attempts to reinstate parts of the Glass-Steagall Act or introduce similar regulations. These proposals aimed to separate risky investment activities from traditional banking to protect federally insured deposits from speculative losses. While full reinstatement did not happen, the discussions highlighted ongoing concerns about the structure and regulation of the banking system. The repeal of Glass-Steagall historically led to the merging of commercial and investment banking, which many link to the financial crisis of 2008. The aftermath of this repeal continues to shape conversations about financial regulation and the balance between innovation, risk, and stability in the financial system.